Hey guys, what's going on today? So today I just want to walk you through the process of me doing a swing trade and a dividend capture. What is it that I look for and why is it that I don't invest in high yield dividend stocks all the time when I do swing trades or dividend captures? Now, normally what people tend to do when they're doing a dividend capture, they want to go after the high yield. And that's fine. I do it myself, but it's not always about the high yield. It's always about the risk and reward as well. You gotta, the more risk you take, the more money you can make, of course. But if you've seen my previous videos, I like to take things in the safer kind of way, like selling covered calls, selling puts. I do buy some options every now and then, but it's an easy way to kind of triple, quadruple your money real fast with buying options. But you can lose your money just as fast as well if you don't know what you're doing. Now on here, simply buying the stock and going for swing trades and dividend captures, they don't really have an expiration date like options do. So that's a great thing about it. Now on Coca-Cola, it's a great company in my opinion, and I would feel very safe, very comfortable holding it for the long term if I'm ever down on it. Now, the reason I'm doing the dividend capture, now I will, for obvious reasons, that the ex-dividend date is coming up on November 29th. And this is actually the 5-day, 5-minute chart yesterday. I was actually hoping that it would drop down in price maybe $2 to $3 more before I got into the stock. However, it went the other way. It just started trending up, and I did miss out on these gains. But throughout the day, I ended up buying, 25 here, 50 there, 25 here, 50 there, and hoping for a dip so I can buy some more. Now, the reason I invested that much money into Coca-Cola is not simply because, I want to do, just hold it for long term and do, capital gains and just do a dividend capture. It's because for me, it's a safer trade. Now, if I do it on something with more volatility, then yes, I might get a little bit more money, but that's a bigger risk for me. Now, having your capital tied up on a stock you don't really like, that's really, something you don't want to do. Even if it's paying out a bigger dividend. Now, this is just on Coca-Cola. Of course, I do it on other stocks, like with higher dividend yields. I do it a lot on REITs like AG&C. I do the dividend capture on that as well as swing trades. So this is just me showing you just what I'm doing on Coca-Cola only because the ex-dividend date is coming up and I feel very comfortable doing it on this with that much money. Now, again, why did I pick this? Well, look at the 5-year chart. We're going to look at it right now. We'll do the 5-year 1-month chart. And it's pretty obvious, it's pretty obvious of what the stock has been doing and it's doing and it's about to do. Now, of course, this is just my opinion, my strategy, of course. So if you look at the 5-year chart, you can see that it's declining and coming right back up in increments, anything between $5 to $10. And slowly but surely, it's getting new highs. So it's a pretty solid stock. And right when it hit the 52-week high, $55.92, it started trending back down. So it's telling you it's pretty obvious that it's going to drop anything between $5 to $10 before it starts going back up again. And that is the reason I tried to kind of buy into the dip, which I kind of missed it, or maybe not, because there might be another dip between now and the ex-dividend date. My whole strategy is to sell any time after the ex-dividend date with a capital gain and collect that dividend. So that's what I'm trying to do. I'm not trying to hold it for the long term, but if I am down and I have to hold it for a little bit longer, that's the thing. I'm not even worried about it. And that's why I'm doing it on Coca-Cola with that much money. Now, if I were to hold Coca-Cola and just keep it for the long term, I'm okay with that, but I know I can make a lot more money doing swing trades on it as well as dividend captures because this stock doesn't really move that much as let's say AMD. Now, speaking of AMD, I'm gonna change the subject just a little bit. I did do a video on AMD selling covered calls, and I was actually gonna make a video on the downside of doing the covered calls. Now, I did do a covered call. I collected $200 in premium or so. And this rarely happens, guys. The stock is at all-time highs, as one of the subscribers mentioned on the comments. And it happened. I had to buy the option back. I overpaid for the option because it was worth a lot more. So I ended up taking a small loss, but I got out of the contract and I have 100 shares again. Well, I still have my 100 shares. And right now I'm up $478 on the stock. And I do plan to write another covered call, but that's a bad thing about it. If it starts shooting up, you lose out on those extra gains. Now, if it would have shot up maybe to like 35.50, maybe $36, I would have been okay with it. But the minute it started just trending up and trending up, I had to buy that option back, and I lost money buying the option back. But on the capital gains, I'm totally fine with that. And I'm probably gonna sell another covered call this week and just keep collecting premium. But that is a good example on when a covered call can go wrong. Well, it doesn't really go wrong. You still make money. You just lose out on the extra capital gains that you could have made, as I've said in the video. And getting back to Coca-Cola, I actually, like I said, I feel very safe doing these kind of strategies on stocks that are great companies. Now, when I do it on something with a higher dividend yield, for example, on AG&C, now this one I do a lot of dividend, captures on throughout the month, and since it pays out monthly, I don't mind holding it for the longer term, as long as it's staying somewhere around the same average price. But for example, on AG&C, I would not put $10,000 in there just to do a dividend capture with a bigger dividend yield, because it's it is a REIT, but I just don't feel safe doing it on these kind of stocks. So that's the strategy behind it. Do it on stocks that you're willing to hold for the longer term if you're really going to invest that much money, or if you're going to invest all your money. If you feel that confident on a stock just to capture a dividend, do it on something, not just because of the yield. Do it on something because it's a great company and you're going to be okay holding it if you can untie that capital at least.